So you've probably heard of credit scores. Maybe you've applied for a student loan or credit card recently, or you have friends or family that are looking into getting a mortgage for a house. We all kind of hear about credit scores in society, but in this video, what I want to do is really explain to you what a credit score is and walk you through who calculates it and all those details to give you a solid understanding of how these credit scores work in Canada so that you can make better financial decisions and just be more aware of this three-digit number that affects us all so much. So in its simplest definition, a credit score is a three-digit number between 300 and 900 usually. And what it does is it gives whoever's looking at it, so usually lenders like banks, or car dealerships looking to give you a loan, what the score does is it gives them an indication of your borrowing history. And it's used to understand how risky you would be to do business with. Are you likely to pay bills on time as agreed? Are you likely to overuse or underuse your credit? So that's the kind of information that this score gives the people that look at it. And this prediction is useful in different scenarios. So banks will look at it when evaluating you for a loan, whether it's a house loan, so a mortgage, or other types of credit that you can get, like a line of credit. But it's also used in other situations. In some background checks, credit checks can be a part of it. And so they're looking at your personal finance situation if you've dealt with credit responsibly. This is called credit worthiness. And whether you're credit worthy or not is based on your past relationship with credit, which the credit score, this three-digit number, summarizes really well. It's kind of like a CV or a resume. When you apply to a job, the first thing they're gonna look at to understand your past history with employment, and if whatever they're offering you is right for you, they're gonna look at your CV as a summary of your past relationship with employment. It's the same here. If a bank is looking to loan you money, they want to know how much money they should lend you. They want to know what terms to put on the loan. Should they have more strict rules on when it needs to be repaid? Should they be comfortable having more relaxed rules? And this is all based on how you've dealt with credit in the past. And so in the same way an employer would look at your resume, a bank or a lender or anyone looking at your credit score is going to look at this number as a summary of your credit report, which is how you've dealt with credit in the past. And so to give you an idea of what they look at, the higher the score, the better. So if your score is higher, that means you've dealt with credit more responsibly or better in the past. And that's going to increase your chances of getting more favorable conditions on a loan, maybe lower interest rates, for example, or it's going to increase your likelihood of getting better credit cards that are maybe for higher income earners, for example, because they know that you've dealt responsibly with credit in the past. So the higher the score, the better. Now, one thing to note is in Canada, we have two different scores that exist. There's the Equifax score and the TransUnion score. You don't need to know these in detail, but essentially we have two different credit bureaus in Canada. And these are two different organizations, Equifax and TransUnion, that each use different formulas to calculate credit scores. I recommend looking into your credit scores in general. It doesn't matter if you're getting one score or the other. And I have a video you can check out on how to do that for free in less than 3 minutes in Canada. It's always a good idea to know your credit score, but it doesn't really matter which one you're looking at because they're very correlated. So Equifax and TransUnion have different formulas they use to calculate their credit scores, but they're all using the same information. And so now, of course, the question you're asking yourself is how the heck is this score calculated? And so I'm going to give you a basic understanding of what goes into the score. But if you want a more detailed view, I recommend you check out my video on how to improve your credit score, where I really go into each one of these factors more in detail and give you tips and tricks to improve your score, knowing what these factors are. But let's get into it. So the first thing is payment history. Have you paid bills or credit cards on time? Have you ever been late? Have you missed payments? That's the first thing, and it's a pretty big chunk of the credit score. Next, there's credit utilization. Credit utilization is how much credit you've used versus how much credit you've had. For example, your credit card, it has a limit. It's what percentage of this limit have you used every month or in the past few months regularly on average. That's another big part of the credit score. Next is credit history, how long you've had credit. So someone that got their first credit card in the past few months, well, they're probably going to have a lower score than someone who's been paying a mortgage down for 10 years because there's just more proof that they are being responsible with credit. And this is at the core really of this factor, which is how long you've held credit for. There's also, and these are a bit less important, but we'll get more into detail in the video on how to improve your credit score about these. There's also types of credit, so your credit mix. Do you only have credit cards and a bunch of them? Do you have a mortgage, a credit card, a student loan? So really the diversity of credit you have. And lastly, inquiries. So inquiries are how many times have lenders or organizations checked your credit score recently or in the past. Now, checking your credit score yourself does not affect the credit score. So this doesn't count. That's what's called a soft check. But if a new credit card application requires checking your credit score, well, that's usually considered a hard check. So if you're applying for a new card or a new loan with a bank, they're going to check your score, and that's considered a hard check. And it does count in your credit score. An important thing to note is that the credit score isn't the end-all be-all. For most banks and most organizations in almost every situation, they're not just going to look at this 3-digit number and be like, okay, we're making our decision. No, so the credit score is only one part of determining your credit worthiness. And so banks and other organizations and lenders are usually going to look at other things like your income, how much money you make every year. They're also maybe going to look at your age or your profession, what you do. So these are all factors that they look into next to the credit score. The credit score is incredibly important because it's usually the first thing and the most weighted thing they see. So it's still very important, but it's not the only thing they see. And now you have a pretty good understanding of what credit scores are in Canada. If you want to check yours for free, which I highly recommend, it takes less than 3 minutes. Check out this video. I'll put the links in the description also. And I'll also link my video on how to improve your credit score, which really goes into detail into these factors we just talked about, what to keep in mind when you're spending money, saving money, making money to improve your credit score and just have a better personal finance situation. All right, thank you for watching and have a great day.